Right now, the stock market is collapsing. And honestly, most investors are panicking. But what if I told you that this is one of the greatest opportunity for investing? Every billionaire investor and every smart investor knows that you buy when the market is red. It's a common slogan in the investing circle. Get greedy when the market is fearful and be fearful when the market is greedy. In case you don't believe me, listen to the oracle himself, Warren Buffett.
I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy.
So today, I'm going to reveal 4 recession-proof stocks that Wall Street billionaires like Warren Buffett are quietly loading up on right now. These are not just ordinary stocks or risky bets. They are Warren Buffett-style bargains with massive dividends, bulletproof balance sheets, and the potential to create generational wealth for you when the market rebounds and many more years into the future. So stick around, because by the end of this video, you will know exactly where to put your money to turn this crash into your biggest payday ever. By the way, depending on when you're watching this video, these stocks I mentioned are still relevant because these are stocks of very solid companies, and if you stick to the end, you will see the numbers and the reason why these are powerful hidden gems that billionaires are investing in right now. And by the way, if you're new here, smash that subscribe button. You won't want to miss what's coming next. Before we dive into these 4 stocks, let me show you exactly how Warren Buffett will analyze them. We are using the 4 timeless metrics that made Buffett the greatest investor alive. The number 1 and the most important one is economic moats. A moat is a company's unbeatable advantage that keep competitors at bay. For instance, Coca-Cola's brand or Amazon's logistics. The wider the moats, the safer the stock. We don't want companies that can be easily overtaken in the next 1 or 2 years by other startups. Okay, we want entrenched companies with very wide moats. The second metric is the dividend yield and payout ratio. Warren Buffett himself loves dividends that grow forever, but only if they are sustainable. Okay, so that's why we are checking for dividend yield. Dividend yield is the cash you earn yearly from your investment as dividends. Somewhere around 4.2% is a sweet spot, which means that every year you get back at least 4.2% of your investments as dividends. We're also looking at the payout ratio. The payout ratio is a percentage of profit that the company pays as dividends. Alright, so we're looking at that, and the sweet spot is somewhere between 40% and 60%. We don't really want companies with very high payout ratio like 80%, okay, because this means that the company is not keeping enough cash for reinvestment into growing the business. At the same time, we don't want companies with very low payouts. Of course, some tech companies don't even pay dividends. We don't want those. We are value investors. It may be okay for those who want to invest in that line, okay, but as a value investor, we want companies that pay us dividends, all right? 40 to 60% is the sweet spot. The third metric we are looking at is the PE ratio. The PE ratio is what tells us if a stock is cheap or expensive at a particular point in time. Now, if you want to know everything about the PE ratio, you can go to the video up here. I have a comprehensive video about PE ratio, so you understand how to use the PE ratio to evaluate whether the price of a company's stock is cheap or expensive. However, we are looking for companies that have PE ratio below 15. Anything above that is really expensive for this particular portfolio. Number 4, we are looking for dividend growth streak. This is very important. Warren Buffett only bets on dividend royalty. When we talk about dividend streak, we mean companies that have been paying dividends consistently for the past 20 years. Now, that shows that these companies are entrenched, which means that some newer companies will not be in this list. We don't want any risky bets. What I'm sharing with you are companies that are very mature, that have strong infrastructure. You will even see a company in our list that has been paying dividends for 50 years consecutively. So you are sure that these companies will continue to pay dividends many more years in the future because of their infrastructure. We're going to look at all of those things. So we're looking at that. And the fifth metric we are looking at are the future potential versus the risk. We must consider the potential of the company to grow more in the future. We must also consider any risk that are facing these companies, okay? Based on these 5 metrics, I'll now reveal to you the 4 recession-proof stocks that you should be buying right now. Starting at number 4 is Bank of America. Bank of America is the second largest US bank. It has massive scale. It's one of those banks that are too big to fail. By the way, one of the major shareholders is Berkshire Hathaway, that's Warren Buffett, which owns 9% of the bank. Bank of America is a money spinner. Dividend yield is 3.2%. PE ratio is 8.5, which is well below the industry average of 12. The payout ratio is 30%, which is extremely safe. It means that every year the bank pays out 30% of their profit to shareholders, okay? So it's extremely safe. They are reinvesting 70%, which is okay. Now, the dividend growth streak is 10 years since 2008. I think among the 4 companies we're going to talk about today, the lowest, but it's also a very good streak. They have maintained 10 years of consistent increase in the dividends they pay out to their shareholders. The compound annual growth rates of the revenue for the past 20 years is 2.5%. Also, since 2014, they've been growing their dividends by 5.3%. And the stock price has also been increasing at the rate of 2.1% from 2004 to 2024. That's for the past 20 years. This is very good because not only is your stock earning you money in terms of dividends, the stock price is also increasing by 2% every year, which means anytime you want to sell, you will not be selling at a loss. You'll be selling it at a higher price than when you bought it. So you have 2 ways of recovering your investment: the stock price, which is increasing, and also the dividends that you are being paid. Looking to the future, we see that Bank of America will continue to make profits as far as finance is concerned in America. And today, with the massive efficiency being driven by AI, we expect more profit margins. However, there is also risk of a recession. If there is a recession, then there may be loan defaults. Banks, including Bank of America, they give out a lot of loans, mortgage, and all of that. So when you have a recession, then many companies may go bankrupt, in which case there may be defaults on those loans. All right? Now, if we look at the charts for Bank of America, okay, you can see that the stock is really down. If you look at the RSI down here, okay, this is oversold. It is down. Selling the stock is very down at this point. There's a lot of selling pressure, meaning that at this point, stocks are very cheap, okay? Now, we don't want to buy stocks when they are up here. This is overbought. And at this point, a lot of people want to take profits and they may crash the stock price, okay? So we want to buy stocks when they are down. And this stock is down right now. How well has this stock been doing? If we go back to maybe 2015, look at the general trend. Though we still have all the usual market cycle, we're looking at the general trend. And I always look at the past 20 years, okay? You can see all the way down here in 2011, this stock was at $4. Okay, so despite the ups and downs, the general trend is upwards. And so we know that historically, the stock will keep on moving up, even though we'll still have the occasional market swing. But as value investors, we're not investing for the next 1 year. We invest for the next 10 years, next 20 years, looking at things that will give us money consistently over a long period of time. And we're also looking at generational wealth. We're looking at building wealth over time. That is the Warren Buffett's formula. Okay, let's look at the next stock. Number 3 on our list is Southern Company, SO. The Southern Company is an American gas and electric utility holding company based in Southern United States. It is the second largest utility company in the United States in terms of customer base because it serves around 9 million customers in 6 states. That is the states of Alabama, Georgia, Illinois, Mississippi, Tennessee, and Virginia. Now, why is Southern Company number 4 on our list? First, let's look at their economic moats. The Southern Company is a money spinner. Why? Because it's a regulated monopoly. Yeah. Because those 6 states where it supplies electricity and gas, it's basically the only company that supplies electricity in those areas. So they are providing critical infrastructure for a particular region in the United States. That is an economic moat. The next 10, 20 years, we're not going to see any other company that is going to come up and provide that level of infrastructure and electricity for those particular states where the certain company is serving. And by the way, looking into the future, they have a big potential. With the coming up of AI is gobbling energy at an alarming rate. And of course, that will only increase energy price, at least energy demand, for the foreseeable future. The dividend yield is 4.2%, which is very perfect. So you are getting 4.2% of your investment every year as dividends. But that's not the only way you're gaining, because their stock is also growing at an annual compound interest of 5.2% since 2004. Every year. So you can see that the stock you buy continue to increase in value while you are also earning dividends. So this is just the winning combo. Alright. Moreover, the PE ratio is very nice at 14.5. Their payout ratio is amazing, 70%. And honestly, paying out 70% of their profits to shareholders is actually risky for most companies, because that means you don't have too much left to reinvest back into the company. But for certain companies, it's not a risk at all. It's stable. Why? Because they have a regulated return. Their return is consistent and stable. Their infrastructures are already in place. And again, you look at their dividend growth streak. For the past 22 years consecutively, the dividend has been growing. So historically, we know that we are safe. All right? Our dividends will keep on increasing year after year. Also, revenue growth is very predictable. For the past 20 years, they have maintained a revenue growth of 3.6% per annum. And the amount they pay as dividends also has been increasing by 3.8% per annum for the past 20 years. So all around, it's just a very wonderful investment, and most importantly, very safe and secure for the foreseeable future. Let's look at the chart very quickly. If you look over here, right now it's trading at $89.24. It's a very robust company. It's recession-proof, because no matter the recession that comes, it won't really affect them. Everybody must use lights, people must use gas and all of that. So this is a recession-proof company to invest in. Now, if you look back historically over the long term, 2018, it was at $44, which is like now it's like double that price right now, because it's at 89 now. So if you look at it historically, keep on going back, you will see that the general trend, despite the usual market cycle, general trend has been upwards. So that's why the Southern Company is number 3 on our list. Now let's go for the number 2 on our list. The second stock on our list is Chevron. Chevron is an integrated oil and gas company. It's involved in the upstream, midstream, and downstream sector. So they do exploration, they do refining, they also have retail stations all across the United States and most parts of the world. Now, their major moat is that they operate on a global scale. They have vast partnership across the world, all the way from Africa, Nigeria, Algeria, Morocco, Saudi Arabia. In fact, they are active in more than 180 countries in the world. So they have massive scale, and that is their major economic moat. It's difficult to replicate that kind of scale. And if you don't know, Chevron is the second largest direct descendant of John Rockefeller's Standard Oil. Remember when the Standard Oil was broken up? Chevron was originally known as Standard Oil Company of California, or SoCal, before it's metamorphosed into Chevron. And it's vertically integrated. It's involved in hydrocarbon exploration, production, refining, marketing, transport, petrochemicals, chemical manufacturing and sales, and also in power generation. Now, if you look at the metrics, the dividend yield is 3.9%. They have a PE ratio of 13, very good. Now, their payout ratio is 50%. Also extremely safe. But more importantly, their dividend growth streak has been going on for 36 consecutive years. So for the past 36 years, they have been paying dividends consistently. This is very important. So even all through the ups and downs, all through the turmoils, all through the oil gluts and all of that, they continued to pay dividends for the past 36 years. Not only that, the dividend itself has been growing at an annual compound growth of 6.5% for the past 20 years. And in addition to that, the stock price itself has been growing at a whopping 6.8% since 2004. That's very impressive. So when you invest in the company, the stock itself is increasing at a rate of 6.8%, and you're also getting dividend yield of 3.9% per annum. These are wonderful, wonderful metrics. In addition to that, looking into the future, Chevron has a lot of potential in the areas of petrochemicals, in the area of oil recovery. They're also into shale oil production, all right? And by the way, every year, Chevron also buys back $14 billion of their shares, which of course improves the share price. That's why their share price is increasing at that rate of 6.8% every year. So the immediate future is looking good for Chevron. Now, it's important to also note that Berkshire Hathaway, which is controlled by Warren Buffett, owns 8% of Chevron. So that is a massive vote of confidence in the financial operation of that company. So this is a good investment for the next 10-20 years. However, we have risk, of course. And the most important risk facing Chevron is the same risk facing all the companies in the fossil fuel industry. That is environmental, social governance, as the world tries to move away from fossil fuel. But it's important to be realistic. Fossil fuel will still be with us for a very long time, not just in the form of petroleum, but also remember that virtually everything we use has some form of petrochemical in it. The clothes we wear, the shoes, the bags, our car, our paint, our drugs, and virtually everything we use has a lot of petrochemicals in them. And Chevron is a giant in petrochemical. And so for the next 50 years, it's absolutely guaranteed that we'll still be using petrochemicals in our everyday life, from the clothes we wear to our paints to chemicals and so on and so forth. However, if you are concerned about ethics, then let's go to our number one pick. AbbVie is an American pharmaceutical company in North Chicago, Illinois. AbbVie has a lot of products. Some of them are products you are very much aware of. One of their major products that most people know is Botox, all right? So in 2023, Botox alone brought in $5.7 billion in revenues. Botox is used in cosmetics for removing wrinkles, improving lips, and stuff like that. They have other products like products that treat autoimmune diseases, like Humira. They have products that treat Crohn's disease, ulcer, and most importantly, in the area of oncology, they have a lot of products for cancer patients like Imbruvica, Venclexta for leukemia and lymphoma, and so many other pharmaceutical products. So why is AbbVie number one on our list? Let's look at the economic moat. AbbVie has a lot of patented drugs, a lot of them. We've already seen Botox, a lot of drugs in oncology, drugs for arthritis, Parkinson's, and so on and so forth. So they have a lot of patented drugs that only AbbVie manufactures or licensed to other pharmaceutical companies to manufacture on behalf of AbbVie. Also, they have a lot of innovative drugs in the pipeline that will be coming out in the next couple of years, which protects them against competition. Also, globally, they are very dominant. For example, the single largest medicine procurement ever done by the NHS in England was for the supply of hepatitis C treatments from AbbVie, okay? So AbbVie has a massive global footprint that secures the company's market share. Also, the dividend yield is 4.1%, which is very sweet, okay? So you're getting 4.1% of your investment back every year as dividends. PE ratio is 14, very okay. That payout ratio is 60%, and that's very nice. So the company pays out 60% of their profits to their shareholders. But most importantly, AbbVie is what you call a dividend king, because they've been paying dividend for the past 52 years. Previously, they were part of Abbott Labs, okay? So they've been paying dividends for the past 52 years. We call it a dividend king. A company like Chevron is a dividend aristocrat because Chevron has been paying dividend for the past 36 years. But AbbVie is a dividend king, all right? So you're almost guaranteed that for the remaining years of your life, you will be getting dividends yearly from AbbVie. But you know what is even more amazing? Since 2013, the stock price of AbbVie has been growing at a compound annual growth rate of 14.2%. That is simply amazing. It completely blows the rest of the companies out of the water. I don't think this will continue forever because it's really, really high, okay? But this means that if you buy the stock today, by next year, you are expecting it to grow at 14% of the price that you bought it today. So not only are you getting a 4% dividend yield on the stock you bought, the price of the stock is also increasing at 14.2% per annum. Moreover, since 2013, when they spun off from Abbott Labs, their dividend has been growing at an annual compound rate of 17.5%. Again, that is simply amazing. And their revenue has also been growing at 9.1% since 2013. All right, so these numbers are just completely mind-blowing, and that's why ABV is number one on our list. Looking at their future potential, between now and 2030, the new drugs that we produce by ABV, which are currently in their pipeline, are expected to yield a revenue of at least $25 billion, according to experts' analysis. Indeed, the future seems very bright for ABV. However, the only two risks that we see with ABV, number one is what we call patent cliff. Some of their drugs will soon lose their patents. Patents are not forever. Patents protect you for a certain number of years, allowing you to recover the costs you invested in producing that drug. But after a couple of years, patents expire. So some of the drugs by ABV, for example, Humira, will soon have their patents expired. All right, so that's number one risk. However, this can be offset by the newer drugs coming into production. The second risk with ABV is that they currently have a debt profile of $63 billion, which they hope to offset with the profits they are making and also the new drugs coming into production. Okay, so these are some of the risks with ABV. A quick look at ABV chart shows that it didn't really go down despite the market shake-up over the past few days. It didn't really go down. It's still here. However, if you look at the RSI is even showing that it's still oversold. All right, meaning that it's actually cheap at this point. But if you look at the chart itself, the price didn't really go down. It just went from 217 to 211. Okay, not much. And so if you look historically at the price, okay, we'll go back and we look at the trend of their price, you can see that the trend has been up despite the occasional market cycle. Okay, somewhere in 2017, you can see that 2017 the price was around $61, okay, which is more than triple what it is today. Trend has been aggressively moving up, much more than all the other companies that we have seen today. And that's also part of the reason why ABV is number one on our list. There you have it, the 4 recession-proof stocks to buy right now while the market is down. These stocks are generational wealth building machines, trading at bargain prices. Remember, the greatest fortunes are built during times like these, when everyone else is panicking, but you're calmly picking up pieces of world-class businesses at a discount. By the way, full disclosure, I'm not making this video on behalf of any of these companies. Of course, I'm buying these stocks myself, but I'm not making these videos to have any personal gain from any of these companies. Just want to share with you stocks that I believe are strong American businesses that will help you to build generational wealth. Okay, all I want you to do for me is that if you gain any kind of value from this video, please smash that like button, subscribe and hit that notification bell, and probably share it with 1 or 2 of your friends who needs to see it. Okay, when the market recovers, of course, they are going to thank you if they follow your advice. Let me also make a disclaimer that I'm not a financial advisor, so please, you should also do your own research before you invest your money in anything, whether it's stocks or crypto, anything at all you want to invest your money, you also need to do your own research. Now, next week, I'm exposing the 3 stocks to dump immediately before the crash gets worse. Okay, you don't want to miss it, so make sure you subscribe. And until then, stay greedy, stay smart, and I'll see you in the next video. Peace.